4. Calculate FCFF and understand what it represents. From revenue to cash that belongs to everyone. FCFF, free cash flow to the firm, answers one specific question. After a company covers its operating costs, pays its taxes, invests in future growth through capital expenditure, and funds the working capital it needs to keep operating, how much cash is left? That remaining cash belongs to everyone who has provided capital to the business, both shareholders and creditors. This is the defining characteristic of FCFF. It sits above the financing layer before interest payments are deducted. When you discount future FCFF at WACC, the result is the enterprise value. The combined value of the claims held by both shareholders and debt holders. FCFF compared to other metrics. EBIT measures operating profit, but ignores the cash the business must reinvest to sustain itself. EBITDA adds depreciation and amortization back to EBIT, making it a useful cash proxy for comparing companies across capital structures, but it still ignores tax, capital expenditure, and working capital. NOPLAT, which stands for Net Operating Profit Less Adjusted Taxes, is EBIT after tax and is the starting point for FCFF. FCFF goes further than all three by also subtracting the actual cash invested back into the business. For NVIDIA in FY 2026, EBIT was $387 million, and EBIT margin was 60.4%. After applying the 15.1% effective tax rate, NOPLAT comes to $110,699 million. FCFF, after also subtracting CapEx and working capital movements, was approximately $91,551 million, representing an FCFF margin of about 42%. The gap between EBIT and FCFF reveals how much cash the business consumes to sustain and grow itself. Part 2. Building FCFF step by step. The standard investment banking formula for FCFF starts from EBIT and adds or subtracts 4 items. EBIT comes from the income statement, specifically the operating income line. The tax rate applied is the effective tax rate from the income statement, not the statutory rate, because it reflects what the company actually pays. D&A, or depreciation and amortization, comes from the cash flow statement as a non-cash add-back, or from the CapEx schedule in a financial model. CapEx comes from the investing section of the cash flow statement and represents cash spent on property, equipment, and other long-term assets. ΔNWC, or the change in net working capital, comes from the working capital schedule and captures the cash consumed or released as accounts receivable, inventory, and payables move with revenue. Applying this to NVIDIA FY 2026. NVIDIA's FY 2026 EBIT was $130,387 million, representing an operating margin of 60.4%. After applying the 15.1% effective tax rate, NOPLAT comes to $110,699 million, reflecting the after-tax earnings the business generated purely from operations. D&A of $2,143 million is added back because it is a non-cash charge that reduced EBIT but did not represent an actual cash outflow. CapEx of $6,042 million is subtracted because it is real cash spent on building and maintaining the infrastructure that drives future revenue. Working capital consumed $15,949 million as NVIDIA's rapid growth required significantly more inventory, receivables, and supplier funding. The result is FCFF of approximately $91,551 million.